Lisa, is this an area of calm? I see spread widening, but I don't see it as a vicious move.
No, it certainly isn't reflecting the same kind of panic that you saw yesterday afternoon in the sell-off in the S&P 500 and the Dow Jones. That said, I do think there has been a change in tone in credit markets. Not to the same degree, it's not panic, but there is a shift in tone where all news is not good news anymore. And I think that this is an important one because all of a sudden you have the specter of inflation with higher benchmark yields. Interestingly, in response, you've seen spread widening. Or you have a stock sell-off and concern about, well, perhaps the rate market's going to derail the economic growth. And that also is negative. And this is a market shift from the Goldilocks that we saw earlier.
Well, let's deal with a couple of things. I think the credit market's view of things has certainly de-risked over the last year or so. I've spoken to so many investors that have taken a more defensive position in credit. That's one part of the story. The second part I want to discuss with you, Jonathan and Gina, is that if something really sinister was happening here, you'd expect a vicious sell-off in credit in the same way you'd get in equity. Surely, Jonathan?
Yeah, I mean, ultimately, both stocks, corporate bonds and stocks are the same thing. It's a call on corporate profits, and if the bond market believed that companies are going to have a hard time repaying debt, then there will be a very, very different issue. And the bond market is saying no, that's clearly not what's going on. There's dislocation. Now, what we do know is that credit spreads and volatility are cousins of each other. They move together. They're both an indication of market risk. But when I'm talking to our credit guys yesterday, and this is very much what you were saying before, they're telling me that they were almost surprised by how orderly things were in credit markets compared to what they were seeing in equities.
Iain Stealey joining us now from JPMorgan Asset Management, fixed income portfolio manager, joining us out of London. Iain, great to have your time. Thank you very much for giving it to us. Can credit remain as resilient as it has been, comparatively so, to equity over the last few weeks?
I think it can, and I think you said it very well. We've seen a lot of people over the last year or so who have been reducing their credit allocation. I don't think it's the frothy market that maybe we're seeing in stocks. And to the point made earlier, these companies are in very good health all around the world. They're going to be able to pay their debt. Default rates are low. So actually that does mean that people still look to buy credit for that extra yield.